The main point of the presentation is to reflect on the advantageous position which Australia finds itself in at the moment from a gas perspective. Australia is very well geographically positioned to target the growing LNG business and the growing gas demand in Southeast Asia. Markets like China, Japan, Taiwan, South Korea and other Southeast Asian countries. Critically, Australia has benefited in recent years from a very strong exploration performance and reserve growth. Coupled with that, at the moment, despite the fact that Australia is already an LNG exporter, their actual market share is still relatively modest, and overall their reserves to production ratio is amongst the highest in the entire world. So the potential for Australia to grow its market share in terms of LNG is actually very, very high. Now, in recent years, Australia has been one of the few success stories in terms of being able to take FID on LNG developments. About 44–45% of FID'd new LNG projects in the 2006 to 2009 timeframe came from Australia. Now, the reason that companies feel so comfortable about investing vast sums of cash, we're talking tens or even hundreds of billions of dollars on these projects, is not only because of this advantageous geographic position and also because of the strong exploration potential and performance, it's also the fact that Australia is perceived as being of low sovereign and of low fiscal risk. The introduction or the proposals to introduce the new Resource Super Profits Tax, RSPT, to some extent challenges that reputation. I'm not suggesting for a moment that companies, as a result of these proposals, would not consider Australia as an attractive place for potential investment. However, it is fair to say that it makes it less attractive. Companies also dislike fiscal uncertainty. There is always uncertainty with all projects in the oil and gas sphere, and particularly with mega projects like we see offshore Western Australia or indeed in the coal seam gas to LNG developments in Queensland. But these sort of uncertainties with regards to costs, to wells, to development schedule, to environmental issues are the sort of problems that the industry is used to. The industry major know and understand these problems, and there's a comfort with that. They get very uncomfortable with things like fiscal uncertainty because it's largely out with their control. So the introduction of the RSPT tax would have a material impact on the economics of these projects. Taking the Queensland coal seam gas to LNG projects first, our model has suggested that the impact could be anywhere between 9 and about 15% reduction in the economic attractiveness or the value of these projects to investors. Now, there's a number of uncertainties about how the proposals would eventually be taken forward to legislation, and I guess that's what the consultation period is about, resolving those issues. But certainly the companies would be looking for reassurance on a number of factors that would make this new tax more palatable, albeit still not as attractive as the existing royalty fiscal terms which govern the onshore areas. Those key areas where the companies would be looking for more detail and more assurances would be with specific regards to the valuation point for the gas, and the companies, effectively discussing what is the effective taxing point that the gas or LNG potentially would be taxed. Companies will look for the government to give assurances that would be as far upstream as possible, which would lower the overall taxable value. Other factors which are definitely under consideration from a company perspective, one of the major ones is the introduction of depreciation. The introduction of depreciation to both onshore and offshore developments would have a material impact. And at the moment, one of the uncertainties is over what period that costs will be depreciated. Once again, companies will be looking for assurances that they will be able to recover their costs as fast as possible, and therefore depreciation rates would be over far more modest timescales than some have suggested. One of the other major negative impacts has been the loss of the uplift which companies have benefited from their investments in Australia to date. The government suggests that the uplift will now be limited to the long-term bond rate, which is considered as being pretty unattractive from an investment perspective. So these are the areas where the government still either needs to provide clarity or more clarity, or indeed potentially can actually give a little back to the industry through the consultation and ultimately negotiation time period. Our model economics has shown that there is an impact through the application of the new tax. From a coal seam gas to LNG perspective, using our model field analysis, there could be a reduction of about 14 or 15% in value. If you were to look at that from a conventional offshore gas to LNG development, that 14% could increase to almost a third because of the nature of how the capex is spent on those projects, with a lot of upfront costs, and therefore the effect of depreciation is far more severe. So I guess the changes that the industry would be looking for, I think it's fair to say, and certainly Wood Mackenzie's opinion, that the government's desire to move to a progressive tax regime that would link profits to government share is a fair and reasonable aspiration. However, the RSPT proposals go somewhat further than that and actually hamper the potential for future investment. I think one of the key objectives with the proposed legislation is actually to achieve a stable and consistent fiscal regime across all non-renewable resources. Now, just how realistic an objective like that is, I think, is open to question. I mean, our economics has demonstrated that coal seam gas projects differ significantly from conventional gas projects in terms of their capital cost profile and indeed in terms of their economics. And also it's important to say that gas projects are not the same as oil projects, and oil and gas projects are not the same as mining projects. So how realistic actually is it to have one common fiscal regime, if you like, across all of those sectors, I think is open to some debate. The government has also started to provide some assurances to offshore players that they will have the opportunity to retain the PRRT progressive regime for some of their developments, and those which are currently proceeding towards FID. Projects like Wheatstone, projects like Browse, like Ichthys, like Greater Sunrise. Now, we would suggest that is it's almost taken as a given. The application of RSPT to some of these developments would in fact kill those developments and they wouldn't proceed. However, if you were to retain the PRRT regime offshore WA and then impose the RSPT regime onshore Queensland, then you have immediately failed in one of your objectives to actually arrive at a consistent regime across the sector. Our analysis suggests that the PRRT is a preferential fiscal regime from an investor's perspective, and therefore it could be argued that the coal seam gas projects, the coal seam gas to LNG projects, are being disadvantaged through the application of RSPT in comparison to the conventional projects who may retain PRRT. And previously with Wood Mackenzie, I looked after our North Africa and Middle East research, so I guess a lot of it's still very new to me. But one thing that's been immediately obvious about Australia is just the actual potential for growth. There's a lot going on in Australia at the moment. There is a whole hopper of potential new LNG projects, and I guess overall the prospects for Australia are very positive. I think it's fair to say that we will see a significant increase in Australia's LNG market share as we go through the next decade. Potentially, if you were to consider all projects going forward, we would be looking at the addition of, in advance of 100 million tonnes per annum of Australian LNG within that time frame. That's unrealistic. Not all projects will proceed, and certainly not all projects will proceed to the schedule which has been suggested. So there'll be those that will be successful and those that will be less successful, which I think identifies one of the key points, one of the key challenges for Australia, and indeed for the Australian government to grasp as well. And that is the appreciation that the LNG market is a very competitive market. Not only are the Australian projects to some extent competing with each other, but there's a whole host of international alternatives who are also looking to target the same prospective and growing Asian market that Australia is looking for. Not only is it that market perspective, but it's also the investment dollars of the industry's major oil and gas companies. And that's why the overall fiscal offering and proposition which Australia puts forward has to remain competitive with what's on offer elsewhere across the world, other companies will simply move their investment elsewhere.